Welcome to the deep dive. So today we're jumping straight into how some pretty innovative financial tools could unlock this massive agricultural potential in transition economy.
We're talking Eastern Europe and the CIS region specifically.
Exactly. Our mission here is to give you a shortcut to understanding the complex, mechanisms that could literally feed the future.
And that future really does rely heavily on this region. I mean, with the global population projected to hit 9.1 billion by 2050, we're going to need a staggering 70% increase in food production.
70%, that's a huge number.
It is. And to get there, countries like Russia, Ukraine, Kazakhstan, they have to become major grain exporters. And making that happen, it demands over $75 billion in private investment.
Okay, let's unpack this. Before we even get to the money, where exactly does that investment need to go? What's the biggest barrier holding back these huge corporate farms?
Well, the primary challenge really is managing risk. For the big players, we're talking farms with thousands of hectares. Extreme weather is the single most critical factor. The sources estimate that drought losses alone, they average a devastating 41 to 52% of expected yield in some of these key areas. You just can't finance that level of uncertainty.
And with that kind of loss, I imagine traditional insurance is just too slow or too complicated. So the innovative fix was this index-based weather insurance. Can you break down how that works?
Absolutely. Index insurance is designed to bypass some major issues, including what we call moral hazard.
Hang on, what's moral hazard in this context?
It's the risk that an insured person might change their behavior because they have insurance. Maybe they don't bother with irrigation because they know they'll get a payout anyway.
Okay, that makes sense.
So index insurance solves this because the payout isn't based on the specific loss on your field. It's based entirely on an objective, measured index like the rainfall recorded at a weather station 50 kilometers away. That makes it cheap and fast.
It sounds perfect on paper, but the Ukraine pilot project, well, it was a failure. What were the pitfalls there that just destroyed farmer trust?
There were two major traps. First, the index product wasn't eligible for the 50% government subsidy that traditional insurance received.
Right.
So it was immediately non-competitive.
Ah.
But the truly surprising part was a timing issue. In one case, the insurance company actually extended the coverage period on its own.
Wait, they extended it. Why on earth would they do that?
They extended it just long enough for some late-season rain to fall. And since the contract was written around total rainfall in that window, that late rain technically canceled out the measured shortfall during the critical planting phase.
So no payout.
No payout. It was a catastrophic loss of confidence.
And if that wasn't enough, there were still these huge institutional roadblocks. Here's where it gets really important. The lack of affordable data.
Precisely. To structure these products, you need reliable long-term weather data. But we saw cases where just getting 30 years of data from a single weather station cost $6,500.
Wow. That's a massive barrier.
Yeah, a huge barrier. And on top of that, government regulations actually prevented bundling the insurance with credit or input purchases, which is the normal, efficient way these products are sold everywhere else.
So even if you solve weather risk, these countries still face this monumental price risk. Weak contract enforcement makes simple fixed-price forward contracts incredibly dangerous, right?
Exactly. That high risk of default is why the warehouse receipt, or WHR system, is such a key institutional tool. A producer can deposit their crops in a licensed warehouse, get a receipt.
And use that receipt as collateral to borrow money.
Yes. This structured approach stops the market from getting flooded right after harvest and helps stabilize prices because farmers can wait for a better time to sell.
And this helps avoid some of the toxic finance models from the past. I'm thinking of those tripartite contracts in Tajikistan's cotton sector with the investors they called futurists. That led to massive defaults.
Those models failed catastrophically. They were systematically extractive. Farmers were, aggressively overcharged for inputs by the investor and then underpaid for their crops at harvest.
So the key here is moving beyond just banks quantifying risk.
It's teaching them to manage risk, using sophisticated structured finance that's backed up by strong institutions.
Here's a thought that ties this all together. Organizational strength. Simply having a commodity exchange isn't enough if it, lacks liquidity and strong rules.
Agreed. The lesson is adaptation. We need these transition countries to look at global best practices, like Brazil's rural bonds or Colombia's repo contracts, and then customize them for their own local, legal, and agricultural realities.
So what does this all mean for you? The challenge isn't just creating these impressive financial instruments. It's about convincing governments and markets that modern financial tools, when they're properly structured and supported, are absolutely worth the systemic overhaul.
And the next step for anyone interested is to explore how policymakers can make sure government subsidies don't accidentally sabotage the very market-driven tools that promise real stability and growth.